He's works for a company comes from a company called Azets. They were formerly Tait Walker, and he's going to talk about, in terms of business, some of the things that we need to consider for the business to be fit for the future. This is going to be the first session of probably some more. So if you know anybody who will get something out of this, please share with your own network. It's a small group. So Lee, were you okay to take questions as and when, or do you want to leave until the end?
Yeah, as and when.
As and when, okay. So thanks very much. I'll hand you over to Lee now. Over to you, Lee.
Perfect. So for the next slide, please, Laura. So just as an intro, my name's Lee Humble. I'm a chartered accountant. I've been in this game just over 16 years. Tend to work in mergers, acquisitions, and capital raising. I've also bought a few businesses, sold a few businesses. I've been a finance director, and I've worked for a couple of different banks. And the one thing I will say is, in every one of those roles, I've always had to look at cash flow and model and project and keep that where it needs to be, which is obviously one of the big things that we need to be very mindful of right now, given the turbulent world that we find ourselves in. So if we go to the next slide, please. In terms of the current landscape, jumping to it, I think it's a high risk environment. Obviously, there are a lot of headwinds facing businesses and management teams right now. Obviously, on screen, you can see some of the big issues. So inflation is something which, from my perspective, has been bubbling away for quite some time, but it's really this year where it's got the kind of front page headlines, which I think it deserves. We hosted an event with the Bank of England last week, or 2 weeks ago, should I say, and actually the projections weren't quite as bad as what I personally thought, but what I do expect is the end of this year is going to be quite tricky. So that inflation should hit around 10% based on current expectation. Obviously, we're well aware of what's happening in the energy market. We've also got a lot of pressure on labour costs, with a lot of movement of staff, a lot of staff expecting certain permission to work from home, etc., which doesn't quite always work. So that is leading to a movement of staff and a problem for business owners in terms of how they retain their staff. Obviously, we've had a lot of government support schemes which followed COVID-19, which are slowly being turned off. So from a debt perspective, we've got the recovery loan scheme, which only runs until the end of June. Now, my personal expectation, based on what I hear elsewhere, is something else may follow. But again, right now, what that is, what it will look like, we do not know. And I don't think it'll be anywhere near as generous as what we had on offer previously. So again, that is something that I would point your attention to, and just make sure that you're following the news and speaking to your accountant, just so you know what's coming down the track and what might be available to you in your business. Obviously, from a debt perspective, a lot of businesses have made the most of the debt schemes on offer. So balance sheets are now carrying a lot more debt than they did previously. Obviously, we're now in a period where payment holidays no longer exist, so that debt needs to be repaid. That will only do one thing to cash flow. It will tighten up, which may then impact a business's ability to pay their own debts on time. What the next slide that I'll come on to relates to insolvency. So Laura, if you can just move on. And this relates to business failure. So what you can see on this graph on screen is 2020, when we went into lockdown. Obviously, the government support schemes came through, and insolvency numbers generally jumped right down. They reduced. But what you can see is in the last few months that has started to come back. And if anything, it's going to surpass anything we've seen previously. What does that do? Well, it means that there's a big impairment risk in the market right now, and you need to be very careful who you're extending credit terms to. The other thing I will say is that HMRC's stance has changed. So we're seeing a lot less leniency from HMRC when it comes to time to pay arrangements, and even little things like research and development claims. So that there are a lot of businesses that put R&D claims in, and they've done very well out of that. But actually, it's becoming a lot more difficult to seek those monetary inputs from HMRC. So that's one thing that I would point your attention toward, and make sure that if you are submitting such claims, you're doing it to a level of detail which leaves you less room for scrutiny. The other part of this, which I think is important, is now that we're seeing insolvency stats increase, the banks are coming under pressure. Obviously, the debt schemes supported by the government include guarantees. some of those guarantees have started to be called upon. So naturally, the government will start to look at lenders and confirm that they have followed the proper process when they've been deploying this capital. What does that mean? Well, as someone who's worked for several banks, the banks will be very, very careful and perhaps overzealous in their recovery and pursuit of people. So again, that's one thing that I'd be careful of. And also, a consistent theme through this presentation is looking at your facilities and confirming that you're not in breach of any covenants and you understand how those facilities work. So as an example, an overdraft is a facility which some businesses may make use of. Overdrafts tend to be something which the bank can remove at no notice at all. So if you're using that, you need to be very, very careful. Next slide, please. So what should you be doing right now? Risk analysis. As corny as it is, you need to understand what risks face your business, and you need to have some form of mitigation strategy in place. Some of those risks hopefully will never come to fruition, but some may well do so, and you need to know what you can and can't do in that circumstance. I think the other part, which some people often miss, is you need to make sure that your financial records are up to date. It's all well and good forecasting your cash flow, but if your opening position is wrong, your projections are unlikely to have any accuracy whatsoever. So you've got to make sure that you are keeping your books and records where they need to be, and you're allowing yourself to project from what is a clean opening position. And from there, you need to make sure that you continue to project, forecast, and consider all the assumptions that you've used as part of your forecasting process as accurate as they can be. You are not going to get this accurate to the penny, but it's very, very simple to make some broad assumptions which can really kill your cash flow if you get them wrong. Next slide, please. So just touching on that, obviously, point number one, you need to make sure your housekeeping is in order. You need to be aware of what financial controls you have in place, and you need to make sure that they are fit for purpose. So the obvious things, such as what is your procurement process? Who signs off purchasing of anything within the business within a certain level? How do you price jobs? Again, that is something as an accountant we often see when we go into model a business in terms of, do you understand how profitable a job may or may not be? Because the last thing you want to do is, grab a big contract, which all of a sudden you realize you're underwater very, very quickly. I think the other thing you need to do is look at your asset base. So I know firsthand that there's a lot of businesses out there who have, a lot of plant machinery. It might be that plant and machinery is subject to certain maintenance programs, but during COVID, it might not have been possible to maintain some of those assets, which, could leave you exposed to breakdown or issue in the coming months, which clearly would leave you in a difficult position. So you need to make sure that everything is working. Your maintenance plans are in place. If you've got new assets to be purchased, have you projected that? Have you budgeted for that? Have you considered whether that asset will be available in the time that you want it? Because again, we know supply chain is a big issue right now. And similarly, employees. Are your teams happy, safe, content? That is a risk which I think all businesses in all sectors are exposed to right now. And there's only so much you can do, but if you've got key players in key positions, you want to make sure that they are content and you don't have any immediate flight risk, which could leave you exposed. I think the other thing that I'll always say is, look at sources of information both within the business and beyond. What are your advisors saying? What are your competitors saying? What are your suppliers, customers doing? Is there anything which suggests they have issues or problems which then could cascade into you and your business? And again, legal frameworks. So the contracts you have in place, do you understand how they work? And importantly, if there are delays, for reasons beyond your control, what does that do to you and your relationship? So are there any financial penalties which could then fall on you, which all of a sudden takes a profitable contract into an unprofitable position? Next slide, please. So one of the things that I've done for this presentation is then model a few scenarios just to show you, simple assumptions. If you get them wrong, what does it potentially do to your cash or your headroom? We're in a position where there's a lot of businesses have taken on a lot of debt, which is great because when you've got initially taken that debt, you've had cash, but some of that cash has started to be spent. You capital position may sort of tighten up. You've got a cost base which is undoubtedly increasing, and you've got bad debt risk on the horizon. So those are all things that you need to monitor, watch, and continue to predict and forecast for, and just make sure that if the worst does happen, it doesn't leave you completely exposed. So if you go to the next slide, please, what we've got is a green line, a blue line. A green line shows you the modeling of a business, a manufacturing business, where they have assumed that their customers are going to pay on 30 days. Now, quite often when I ask clients, how quickly a customers pay, they'll say 30 days because that is the contractual terms in place. But actually, when you pick up the size, you realize customers aren't paying on 30 days, they're paying on 60. They might be paying on 90. That has a huge impact on your cash flow. So in this scenario, what you can see, the blue line, it drops down very, very quickly when we've changed that assumption from 30 days to 60. And crucially, what this doesn't show is if you did do that, the unwind of the opening position would also take you further south. So very quickly, you go from a position where you've got lots of headroom to a position where you've got no headroom. So that's the first place I'd point your attention toward. Are people paying on time or not? If they're not paying on time, clearly you need to understand why. Because it might be that that is a customer that from a risk perspective, you may need to change your T's and C's with, or make a decision as to whether you want to continue to trade with them. Next slide, please. So again, one of the financial facilities which a lot of people use is invoice discounting, where in essence, a funder will advance you an amount of capital based on when your invoices are raised. Within those agreements, the funder has certain permission to change and manipulate your funding line. So that can relate to things such as customer concentration. So if you are too reliant on one customer, they will reduce your funding. Similarly, if the credit rating of a customer drops, they have the ability to remove funding. It may be that if a customer takes too long to pay, they can remove funding. If a customer is also a supplier, they will not be funded. So what this shows is if any of those scenarios unfold and a reserve is applied to that facility, immediately your headroom drops. Now, I've seen that take a business underwater very, very quickly, especially where you've got perhaps customers filing accounts and all of a sudden their credit rating drops. That is a scenario where your funding will contract very, very quickly, which is why you need to be speaking to those customers and listening to them. Next slide, please. Again, this is a scenario where, and this tends to hit smaller businesses more than larger businesses, but some shareholders will extract their own payment via dividends rather than salary. That is a simple assumption to miss completely when you project cash flow. So for a small business where you might have quite significant shareholder remuneration, again, by the time you start to model that impact, cash flow can start to drop quickly. So you just need to make sure that you've captured that and you know who's taking what when. Again, another assumption which can fall into similar categories is where you've got a capital acquisition. So is that in your cash flow or not? And importantly, when you're buying assets, what are the payment terms? Are you paying up front, or is it that you've paid a deposit and certain amounts down the line? And again, have you modeled those in the timelines which are most realistic? Next scenario, please. So what we've got here is invoice timing. And this right here is why finance teams need to speak to those on the ground, your sales people, your commercial people, and your ops people. This scenario is where you've made a sale, but the sale shifts from one VAT quarter to the next. And what it shows is very quickly your cash can jump. It jumps significantly because all of a sudden the input versus output VAT, that balance has changed. It's shifted. You've pushed it into the next month. So all of a sudden your cash, the amount you need to pay or reclaim will move. So that's why I'd always say is you've got to speak to your finance teams, especially for big critical orders, because where that drops, it's going to have a big impact. Next page, please. Again, this is a very real scenario right now, and this is all related to creditor days. So your suppliers will give you certain credit terms. It may be that you're on 30 days, you're paying on 45. It might be that you're on 60 if you've got a generous supplier. But if a supplier has their own cash pressure, or if they perceive risk in trading with you, they may well reduce those credit terms. So what this does, it takes a creditor days from 45 to 15. Now, again, if you've got suppliers asking for payment up front, it will have a very notable impact on your cash flow. And then if we go to the next slide, what we've got is the overlay of all of the above. And very quickly, the position looks pretty bleak. So I think the one takeaway that I would kind of point everybody towards today is just, you know, when you're modeling, just critique your own assumptions and continue to do that, because your circumstances will change. We're in a very volatile world where all of a sudden things can move very, very quickly. And you and your entire team need to be aware of that, because if you've got salespeople on the road who want to make a sale, you know, they need to know why a certain sale may not want to be pursued, or they might want to know why the payment terms have changed. So again, that internal communication is key.
I've got I was just an observation, Lee. When I had my own business and I was on the consultancy side, I had worked for a big consultancy, and what we'd done, we're only around for 3.5 years, but we actually, when I quoted a job, when I got the acceptance of that job, I invoiced 50%. The clock was ticking, 50% as soon as that acknowledgement was raised, and then halfway through the job, the other 50. And I didn't think people would be receptive to that, but they were.
Yeah, well, I think it's a very good point, because we're in a world now where everybody understands what you've got to do to keep your head above water. And again, it comes down to communication. You know, if you can communicate that message to your customer and explain why, it tends to be that they are amenable to it to an extent. Again, if you've got the example of a sales teams don't like that because they potentially see an obstacle, but it's critical to the viability of your business that you're doing things in a way which your business can support. So it's a very, very good point. Very good point. If I can go to the next slide, please, Laura. What I'd like to talk about now is just some of the things that I think you should be doing just to stay on the front foot. So again, facilities, you know, how much cash do you have in the business? What lending is in place? How does that lending work? That lending may have security in place. So if you look at your balance sheet, what assets are encumbered and what are not encumbered, because again, that might indicate where you've perhaps got more capacity for additional debt should you need it. Now, again, you've got to be careful, because you don't want to keep on stacking debt upon debt, because debt needs repaying. But you just need to know where everything sits and how it works. From there, again, you know, touching back on the contractual terms and conditions. If things slow down, if you can't hit your time plan with certain customers and indeed with your own suppliers, what does that mean? Can you pass on cost increases? Can you not? Are there any penalties for late delivery? So, you know, just keep monitoring those stakeholders. You know, stakeholders, that covers a massive list of different parties. You've got your staff, you've got your customers, you've got your suppliers. HMRC are one that I'd say you need to be talking to. The one trap I think a lot of businesses fall into when they have cash issue is they just stop paying the tax. Again, during COVID and lockdowns, HMRC were flexible, but for those who've taken use of that without formally communicating, they're starting to see demands come in from HMRC. And the key thing there is, if you speak to HMRC, you need to outline why there's a cash issue, and importantly for them, how you're going to pay them back. And, you know, the trap again there is, some people think, oh, I'll pay them back over 5-10 years. It's very, very rare that they're going to agree to an extended payment profile. They're going to want to see something fairly soon, and they're going to want to see things like financial projections to demonstrate that what you're telling them is a reality. And then I guess the last point is communication. You know, it's a message that we're being consistent with throughout every slide. You need to talk to everybody. Now, whether a certain message that you might want to control to your competitors and your suppliers and customers for that matter, but you just need to make sure that everybody knows what you're doing and why. And then if we move on to the last slide, this is just touching on, you know, what you do if cash really tightens up and you've got a big issue. Obviously, you need to look at your balance sheet. You need to look at your lending. You need to consider if there is debt in place, can you make use of payment holidays? And crucially, what is the process with the lender to explore that? Because quite often you can't just turn off payments, and you need to know what covenants are in place. So you might turn one thing off and you might breach something else, which all of a sudden leads to a bigger issue. You know, temporary funding facilities from a bank aren't easy to attain. The key there is communicating with the bank and explaining what the issue is, why it has arisen, and how you get yourself out. A bank is unlikely to extend additional facilities to someone where they perceive an imminent risk. Look at the terms you've got from your own suppliers. Are there any terms that can be pushed? Again, you need to be careful with the communication, explaining why it is that you need to move those terms. And again, look at things like your landlord. Landlords have been forced to be a lot more lenient of late. So I guess for a lot of landlords, that they're not going to have as much slack for you. But the commercial reality is, if you stop paying, what are they going to do? Can they replace you in 30 days? I suspect not, but you need to do the right thing. You need to do the fair thing and tell them what's happening and why. And then when you start to get really extreme, you know, we've talked about HMRC, but staff, you know, the discretionary expenditure, which a lot of businesses pay, whether it's marketing, bonuses, etc., you know, a lot of really important emotive topics, but things which can make a big difference when you're really feeling the heat on your back. And you've just got to keep up to date with your modeling. You know, when you're in this scenario, you need to be modeling cash weekly, if not daily. And you need to make sure that every payment you make has got the agreement of all key internal stakeholders. So again, in my finance director days, we had a very large security business where we made use of subcontract manpower. And every week we had certain payments to be made, which, you know, the ops guys would come to me and say, we want to make payments to these people. And sometimes I had to say, not an option. This is the amount we've got. You tell me who's most critical, and we'll then sign those payments off. Now, that was a very difficult position, and we ended up in that position because we had 3 very big bad debts in quick succession. So our cash flow tightened up very, very quickly. And that's a business where ultimately we had to call the bank in to kind of work our way through the process and get ourselves back into a positive territory, which we did, but it took a long time. And the one thing I will say is, if you do find yourself in that scenario, that predicament, feel free to reach out. You know, I've done it before. It's a very difficult process to manage, but it's not uncommon. And I do think that as we hit the autumn and the winter, there's going to be a lot of businesses which start to creak. They're going to find it very, very difficult. So it's important that, you know, you take support and advice from those who know how these things work. And that's it from me. So has anybody got any questions or observations based on what we've covered? I appreciate I've talked very quickly, covered a lot of ground.
I think we'll open it up, Lee. I think that what I like about Lee is that he gets to the point very quickly, and he actually makes it sound really interesting, which is quite unusual in these kind of subjects. So has anybody got any burning questions you want to ask Lee?
I think from my point, Lee, that definitely